Markets hit record highs. Politicians promise soft landings. But behind the applause, the same debt bomb that exploded in 2008 is ticking again. Only this time, it's not just banks. It's entire nations on the line. You've seen the headlines. Inflation cooling, growth returning, the crisis averted. But have you asked why central banks are quietly hoarding gold at rates not seen since 1967? Here's what doesn't add up. Global debt reached $305 trillion in 2024. That's 330% of global GDP, the highest ratio in peacetime history. Yet bond markets remain calm, yields stable, credit spreads tight. Either the market is smarter than ever, or it's ignoring the obvious. We've been here before. Summer of 2007, real estate prices peaked, credit was cheap, banks reported record profits. The Fed chair said subprime was contained. 12 months later, Lehman Brothers collapsed. The difference now? The leverage isn't hidden in mortgage derivatives. It's sitting on sovereign balance sheets in plain sight. Let me explain how this works. When interest rates were near zero, governments borrowed massively. Infrastructure, stimulus, pandemic response. The debt was cheap, so nobody worried. But now rates have tripled. Japan pays $50 billion more per year just on interest. Italy, $30 billion. The US? An additional $400 billion annually. That's more than the defense budget increase. Here's where it gets dangerous. Higher debt service means less money for everything else. Growth slows, tax revenue falls, deficits widen, so governments borrow more, which raises yields further. This is what economists call a debt spiral, and it's already begun in 12 countries. Think of it this way. Argentina in 2001 was the Jeff Bezos of nations, rich in resources, confident in growth, borrowing in foreign currency. Then the peso collapsed. Overnight, debts doubled in real terms. Default became inevitable. Today, 17 nations have debt to GDP ratios higher than Argentina did then, and 8 of them are considered developed economies. The risk isn't in emerging markets anymore. It's moved to the core. So why isn't this front page news? Because everyone benefits from the silence. Politicians need cheap credit for campaigns. Banks profit from issuance fees. Central banks can't trigger panic. And media? Most financial journalism is sponsored by those same banks. But here's what matters most. This isn't about numbers anymore. It's about trust. When Argentina defaulted, investors lost faith in emerging markets for a decade. When Greece nearly left the euro, trust in the European project cracked. If a major economy, say Italy or Japan, faces a debt crisis, what breaks isn't just their bond market. It's confidence in the entire system of sovereign debt, and that trust is already eroding. In 2023, foreign holdings of U.S. Treasury bonds fell for the first time in 40 years. China and Japan, the two largest holders, reduced their positions by $180 billion combined. They're not selling because they don't need dollars. They're selling because they see the math. Here's why 2026 matters. Between now and the end of 2026, $15 trillion in government debt needs to be refinanced globally. Most of it was issued when rates were near zero. Now it rolls over at triple the cost. For context, that's like your mortgage payment suddenly going from $2,000 to $6,000 a month for entire countries, all at once. This isn't a hypothetical scenario. It's scheduled, and here's the kicker. Unlike 2008, there's no consensus rescue plan. The dollar is under pressure. The euro faces structural issues. China's yuan isn't ready for reserve status. So when a crisis hits, there's no clear safe haven. Gold jumped 40% in the last 2 years for a reason. Central banks aren't buying it for decoration. You might think central banks will just print more money. They tried that. Inflation hit 9%. Now they're stuck. Print more and inflation returns. Don't print and defaults multiply. This is the trap Japan fell into in the 1990s. They called it the lost decade. It lasted 30 years, and their debt ratio was half what major economies face now. But wait, there's another layer. The derivatives market tied to sovereign debt is worth $600 trillion notional value. That's 7 times global GDP. These are the insurance contracts, credit default swaps, interest rate swaps that banks use to hedge government bonds. If one major sovereign defaults, these contracts trigger, and unlike 2008, there's no AIG to bail out the system. The exposure is distributed globally. A default in Tokyo could freeze credit in Toronto, and here's what makes this truly dangerous. Geopolitical tensions are rising. Russia and the West aren't trading. China and the US are competing. The globalized system that allowed smooth debt recycling, China buying US bonds, Europe buying Asian exports, is fragmenting. Debt crises don't happen in stable systems. They happen when the system itself is under stress. You've probably noticed something. Every time there's a warning, markets rally. Bad jobs report, Fed might cut rates. Inflation spike, priced in already. Bank failure, regional issue only. This is called bad news is good news trading. It works until it doesn't. In 2007, Bear Stearns collapsed in March. The market hit new highs in July, then Lehman happened. The pattern repeats because human nature doesn't change. Here's what's already happening behind the scenes. Ultra-wealthy investors, the ones with direct access to Treasury officials and Fed governors, are repositioning out of long-term bonds into real assets, gold, land, energy infrastructure. This isn't conspiracy, it's public record in SEC filings. When the people closest to the system start moving, you should pay attention, and here's who gets hurt most. Pension funds. They're required by law to hold safe government bonds. CalPERS, California's public pension fund, holds $180 billion in bonds. If rates spike another 2%, that portfolio loses $30 billion in value. That's retirement money for teachers, firefighters, nurses. They can't move to gold or real estate. They're locked in by regulation. The rules designed to protect them have become the trap. History offers a warning. In 1971, the US closed the gold window. Overnight, the entire Bretton Woods system ended. Countries that held dollars lost 30% of their wealth in real terms within 2 years. It wasn't a crash, it was a reset, and everyone saw it coming. They just didn't believe it would actually happen, so governments face a choice. Default explicitly, admit they can't pay and negotiate haircuts with creditors. Or default implicitly, keep printing money and let inflation erode the debt's real value. Either way, someone pays. The question is who? Bondholders? Taxpayers? Or everyday people through inflation? Based on history, you can guess which option politicians prefer. The real danger isn't the amount of debt. It's the speed of change. In 2008, the crisis took 18 months from first cracks to full collapse. That was slow enough for governments to coordinate. Today, with algorithmic trading and instant global communication, a crisis could cascade in days, maybe hours. The system is faster. The buffers are smaller, and it's not just governments. Corporate debt hit $13 trillion in 2024. Much of it rated BBB, one level above junk. When rates rose, companies couldn't refinance. Bed Bath & Beyond collapsed. Silicon Valley Bank failed. These weren't mismanaged businesses. They were victims of a rate environment they couldn't survive. Now multiply that across the entire corporate bond market. Here's the paradox most people miss. When debt becomes unsustainable, the natural response is deflation, not inflation. People and businesses pay down debt instead of spending. Prices fall, but falling prices make existing debt more expensive in real terms. So they cut spending more. Japan experienced this for decades. Once it starts, it's incredibly hard to stop, and it makes the debt problem worse, not better. Now you'll hear a different story from mainstream sources. They'll say debt doesn't matter because we owe it to ourselves, or that governments can't default in their own currency. Both statements are technically true, and both miss the point. The question isn't can they pay, it's what happens to the currency when they do. Think of inflation as a tax that doesn't require a vote. Government borrows $100 billion, prints money to pay it back. Your savings lose 10% of their value. The debt gets paid, but you're poorer. It's the oldest trick in the fiscal playbook. Rome did it by clipping coins. We do it with monetary policy. The mechanism changes. The transfer of wealth stays the same. Watch what's happening in real time. Turkey's lira lost 80% since 2021. Argentina's peso, 90%. Lebanon's pound collapsed entirely. These aren't random events. They're case studies of debt crises in motion. The pattern is always the same. Borrow in good times. Rates rise. Currency weakens. Inflation spikes. Social unrest follows. The variables change. The sequence doesn't. Here's what people forget. Money isn't just economics. It's a social contract. We accept pieces of paper and digital entries because we trust the system behind them. When Argentina's middle class saw their savings evaporate overnight, that trust broke. It took 20 years to rebuild, and in some ways, it never fully returned. When trust breaks at scale, you don't just get an economic crisis, you get a legitimacy crisis. Can this continue for years? Possibly. Japan's debt ratio passed 200% in 2010. They're still functioning. But Japan has unique advantages: a captive domestic market, low defense spending, cultural cohesion. Most countries don't have those buffers. And even Japan is starting to wobble as their population ages and their debt service grows. Remember 2008's lesson. The problem wasn't subprime mortgages. It was the 30-to-1 leverage on top of them. A small decline became catastrophic because of amplification. Today's leverage is different but just as dangerous. Sovereign debt trades on repo markets. Pension funds use derivatives. A 5% bond decline becomes a 50% capital loss when you're leveraged 10-to-1, and everyone is leveraged. So where do you go? Gold has counterparty risk through ETFs. Real estate requires liquidity. Cash loses to inflation. Crypto remains volatile and unproven. This is why central banks are scrambling. They don't have a playbook for a synchronized global debt crisis in a multipolar world. The old rules assumed US hegemony and dollar supremacy. Both are now contested. It's the same logic driving markets in 2025. AI optimism, rate cut hopes, soft landing narratives, these aren't wrong predictions. They're necessary beliefs, because if the market truly priced in the debt crisis, yields would spike, triggering the very crisis everyone's trying to avoid. So we get collective suspension of disbelief until we can't afford to anymore. Talk to anyone who worked through the Latin American debt crisis of the 1980s or the Asian financial crisis of 1997. They all say the same thing. The warning signs were obvious. The smart money was moving, but the consensus view stayed optimistic until the day it didn't. The market can stay irrational longer than you can stay solvent. But eventually, math wins. It always does. So here's where we are. The debt is scheduled to refinance. The rates are locked in. The timeline is set. 2026 isn't a prediction. It's a calendar event. What happens after depends on decisions being made right now, behind closed doors, in Basel, Washington, Beijing, Frankfurt. You won't hear about them until they're announced. By then, it's too late to position. Every financial crisis follows the same arc. First they deny it, then they contain it, then they manage it, then it explodes anyway. We're somewhere between contain and manage right now. The explosion isn't guaranteed, but the conditions are. And unlike past crises, this one doesn't have a clear external enemy. No subprime lenders to blame, no rogue traders, just democratic governments doing what they're designed to do. Borrowing for today, deferring payment to tomorrow. So here's the question they don't want you to ask. If the system is built on ever-increasing debt, and debt is reaching its mathematical limits, what happens when trust breaks? Not if, when. Because 2026 isn't a crash waiting to happen. It's the year we'll remember as the moment the system admitted it couldn't pay its own promises.